Welcome to this lecture on VAT. VAT is a very important topic, not only because we see it or encounter it almost every day when we go out and we buy things, but also because of its importance to the CTA syllabus. This is a topic that can be asked throughout the year, and it can be integrated into most questions. So it is a very, very important topic. It is also a topic that you've encountered previously in maybe your undergraduate studies, but for a lot of students, this is also a topic which I find students would have been able to do some calculations and basic things without really understanding how it works and where it comes from. So it's important for you to make sure that you do understand it quite well. Now, you'll see that the lecture is split into two parts, part 1 and part 2. This is the start of part 1. Part 1, I cover a lot of the basic principles, things that you should have mastered in your undergrad, I would say. Now, you need to take a moment and think about it as we're going along, about how well you know this. Don't neglect this part of it. Don't just assume that you know it. Go through it and see. A lot of you guys do have gaps in your knowledge about how VAT actually works. Part 2, we go into a little bit more of the complicated and advanced things. Some of it you've also seen already in the past, but there are a little bit more of the complicated issues. Okay, so let's have a little start this lecture. We talk about VAT as a little bit of an introduction. The first thing that you need to know, or that you might have heard, is that VAT is an indirect tax. Now, what an indirect tax means when they say that is it means that the people who pay it are not the ones who fill in tax returns and pay it across to SARS. So, when you think about income tax, your personal income tax, that is not an indirect tax, it's a direct tax, because you have to complete a tax return, submit it, and then pay across an amount to SARS. But how does an indirect tax work? Well, an indirect tax, if I use this as a little simple example, let's say you go to the store and you buy something for 115 rands, including VAT. That means that you will get an invoice from the store that says the following. It says the cost excluding VAT, the selling price excluding VAT, let's just call it cost for now. Cost ex VAT is 100. It will tell you that the VAT on that is 15 rands, because VAT is currently being calculated at 15%, and that means that the total is 115. So you pay 115 rands. But what is that 115 rands? It is 15 rands VAT and 100 rands, which is the cost price. That 15 rands VAT, the shop owner, the person that sold you to, must pay it to SARS. So, who's actually paying for it? You, because you're spending 115 rands instead of just 100 rands. So you are paying for it indirectly. It's an indirect tax because you're paying it, but the shop owner must pay it across to SARS. Alright, so, important, as I've just mentioned, VAT is currently being calculated at 15%. Before the 1st of April 2018, it was calculated at 14%. This VAT rate can change. It hasn't changed for a long time before the 1st of April 2018. Since its introduction, it was basically at 14%. But it can change, and if that is the case, obviously your calculations will just take that into account. But what is important for you to understand is that VAT is not just calculated at 15%, it's calculated at 0% as well. So this is an important concept for you to understand. There are two different VAT percentages. The one is 15% and the other one is 0%. These are both called taxable supplies, and it's an important term that for you to understand. It's a term that actually has a definition in section 1 of the VAT Act as well. A lot of you will remember from your previous studies that you also get something called exempt supplies. Now, exempt supplies means it is something which is not subject to VAT at all. Like, for example, if you earn interest from the bank, that's a financial service which is exempt. there's no VAT on it. Now, you might say, but that's then the same as 0%, but it's not. An exempt supplier just basically means you don't even consider it for VAT. 0% means the VAT is calculated at 0%. So here in this invoice I had, where it said cost excluding VAT is 100, VAT is 15%. If it was zero rated, so 0%, the VAT would be 0 and the total would be 100. That 100 is then considered an amount including VAT. But how much is the VAT? 0 rands. I know you might feel like, but if you do it in the calculation, if we just think about it in the calculation form, it's exactly the same. Yes, you're not wrong, but there are very important implications, because if you make taxable supplies, like we see here, you can claim input tax, input VAT, some of you might call it. If you don't make taxable supplies, if you make exempt supplies, you can't. So this shop owner here, selling the VAT at 0%, this shop owner can claim input tax. So for all of the other things that the shop owner pays, he or she can claim input tax on that. And you'll see as we go along, it'll become a lot more clear. Now, the first thing I want to just make a comment on this next page is that you'll see that it is important for you to refer to it as output tax and input tax, and not as output VAT and input VAT. Now, it's a small minor detail you might think, but please understand it's because the VAT Act specifically refers to it as output tax and input tax, and to be correct in an exam, they'll require you to call it output tax and input tax. So just pay attention to that, guys. You'll occasionally hear us refer, and you might refer to as output VAT and input VAT, and that's fine just for explanation. But when you're writing an exam, test output tax, input tax, please. A couple of comments also here. You must learn how to use the VAT Act. And as we go through this lecture, you'll see that we'll touch on a lot of aspects with it, but please make sure that you've spent enough time with the VAT Act so that you can use it effectively in an exam. You will especially need that when you're looking at discussion questions. Okay, now remember also, just one quick little comment before I move on from that. You have to practice with the Act before you go and write a test or an exam. No one at this level will just be able to go into the exam or test, pick up the Act if they've never done it before, and find the answers there. If you haven't practiced with the Act, and you haven't used it when studying at home, there's no even point in taking it with you into the exam. So practice with it. It's the only way that you'll get better at it. It does take time, it does take patience, but it's one of those things I highly recommend. Now, as a quick comment, you'll see as we go along through all the classes and through the rest of the lecture, it's important for you to be able to discuss the following three aspects of each VAT transaction. You need to know what is the timing of the transaction, what is the value rule, and what is any other special rule that might be applied to it. So, for example, the majority of the time, the timing tells you it is the earlier of invoice or payment, but there are other rules also where it might be the earlier of the due date or payment, or the date when it is delivered, or the date when the property is transferred and registered in the taxpayer's name. Whatever the case might be, it's important for you to understand there are different timing rules, there are sometimes different value rules, and sometimes there are all sorts of special rules. That is what you need to concentrate on as you go along. For each transaction, you need to be able to ask yourself, do I know what the timing rule is for this? Do I know what the value rule is? And do I know if there's any special rule? If you can't answer that, you don't know your work well enough yet. Okay, so focus on that as we go along. If you're aware of it and you pay attention to it, you'll see it won't be a problem for you. A little comment here at the bottom, I'm going to explain to you also in a second. You'll see that as we know, there's output tax and there is input tax. And sometimes when students study, they mix the two up and they don't really pay attention to how and why and which one we should use. Understand that the approach that we're going to be following is that we are going to focus on output tax. If you know what the output tax rule is, you know what the input tax is going to be. The output tax determines what the input tax is. And you'll see that in a few seconds when I start doing some basic principles with you. Now, at this point, I'm going to start and I'm going to show you some basic scenarios. Now, this is especially important for students who are a little bit unsure of how VAT just practically works. So if you in your undergrad studies maybe just learn how to do calculations without really understanding what you're doing and how it works and what's the difference between output and input tax, this is very important to you. What I would recommend that you do is I recommend that you go and look at lecture example 1 and you use lecture example 1, which is just the basics, to determine where and how much you know. So I would recommend you pause this video here, go and look at lecture example 1. If you are very comfortable with lecture example 1 and none of those examples you made any mistakes with or any errors with, then you don't have to watch the rest of this video. However, if you are uncertain there about lecture example 1, which is really the basics, then I recommend that you continue watching the rest of this video. Okay, so go and look at lecture example 1 now, see if you can do it. If not, please continue watching this video. Okay, so I'm going to now go through some of the basic examples or basic principles around this. You'll see now why I say we need to study from output tax. Okay, so what I want you to understand, and this is what we're going to use throughout all of these little couple of examples, is that we have two taxpayers, taxpayer X, taxpayer Y. Taxpayer X sells something to Y. Okay, so Y is buying something from X. That's the idea that we're going to be using here. Okay, at the time when taxpayer X sells something, taxpayer X will give Y an invoice. This invoice here, what it says, just zoom in a little bit, is it says selling price excluding VAT, VAT and total selling price. So this is the standard thing which I'm going to be using. Okay, so let's start off with the following. Okay, so with that. So let's say you go to the store, and this is you. You are now Y, and you are not a VAT vendor, which is most of us. You and me, if I go to the store, I'm not a VAT vendor. And X is the store, and this is a VAT vendor. Okay, so if you go to the store and you buy something for 100 rands, I'm just going to use this simple example the whole time. They charge you VAT at 15%. It means that you pay a total of 115 rands. Okay, so now let's understand what this means. So when we're looking at this X now, X will have the following cash flows. The total received will be 115 rands. It's a positive amount. Okay, because you pay the shop 115 rands. X will then pay output tax. That same output tax that you see over there, will pay that to SARS. So the net cash flow for X is 100 rands. From your perspective, right, Y, you will pay 115 rands. It's negative because that's what you're paying as a negative outflow. I'm sure I was talking still about cash flows. Input tax is tax that you can claim. Can you claim it? You can't claim it because you're not a VAT vendor. You and me. So that means that the net amount is 115 rands that flows out from you. That's how much it costs you. Now let's look at SARS. SARS will receive the output tax. That 15 rands from X will receive it. And it will have to pay you the input tax that you claimed, which is nothing. So I want you to understand that SARS makes 15 rands. So SARS collects 15 rands. So when you and I go to the store and we buy something, SARS makes the VAT amount. Okay, nice and simple, right? Let's look at the next one. Okay, so now we have X again. It's a VAT vendor. Y now in this case is also a VAT vendor. So 100 rands, VAT 15, total 115. Okay, here we go. X, again, cash flows. Total that they receive is that 115. The output tax that they have to pay across to SARS as a VAT vendor is that 15. So it's a cash outflow. So they make 100 rands. That's the net. Here's Y, also cash flow still. The total that they have to spend is 115. They can now claim input tax. Now, important. How do you know what the input tax amount is? Now, when you've studied, you would have seen that we do this calculation, say 115, which is the amount including VAT, times 15 over 115. That gives us 15. Or sometimes they'll give you the 100 rands, which is the amount excluding VAT, and you have to say times 15%. Right. Either one of these can be asked or given. Now, what I want you to understand is, in reality, that is not how you calculate the input tax. The input tax is not performed through a calculation like this. In reality, how it works, and this is what the aspect is what a lot of people miss. In reality, this VAT vendor Y must have an invoice, a VAT invoice that they receive from someone. That's a requirement to claim input tax. And the VAT that they can claim is the VAT that is on this invoice, which is that 15 rands. All right, so that's the VAT that they can claim. Now, I know that sounds silly, but why am I saying this to you? I'm saying this to you because I want you to understand that it's not just a calculation. It is from an invoice. And that invoice there is the invoice that shows you the output tax. So, how do we know what the input tax is? It is whatever the output tax was. That's why when we approach tax in our VAT in our studies, we study it from the output tax side. Because if you know what this invoice says, then you know what the input tax is. Now, in an exam, they will give you these amounts and they'll say to you, you have to calculate it. And that's only because they can't give you a whole big stack of invoices to work through. But understand where it comes from. It's not a calculation, it actually comes from an invoice. Very important, guys. If you don't have that invoice, you can't claim it. So let's look at Y. Y spends 115 rands cash outflow, claims 15 rands in VAT. So that means the net amount is 100 rands. Now let's look at SARS. This is the cash flow for SARS. So SARS collects output tax of, sorry, it's not a negative amount. SARS collects this 15 rands and it has to pay back input tax, which is that amount. So how much money does SARS make? Nil from this. So if two VAT vendors buy from each other, SARS does not get VAT. They can both, the one pays output tax, the other one claims input tax. SARS doesn't make any money. So that's why it's a consumer tax. The person that pays it, if I take you back to our first example where it said it's you who's not a VAT vendor, it's you and me that can't claim the VAT. We're the ones that pay it. Okay, now let's look at this as an example. X is not a VAT vendor. Y is a VAT vendor. So X sells something for 100 rands. They can't charge VAT because they're not a vendor. So the total is 100 rands. X, the cash flow, is the total, which is this total over here. The output tax, that over there is nothing. So they make 100 rands. Y, the total, is this 100 rands over here. The input tax is, you go to the invoice, and what's the input tax that you can claim there? Nothing. Alright, so the net amount is 100. Okay, now source, output, and input, nothing and nothing. There we go. Now, I'm going to just make one comment there. There's one exception to this, and that is second-hand goods. If Y purchase second-hand goods from a non-VAT vendor, then they can claim what they call notional input tax. And there will be an amount that you can claim over here. I'm not going to go into that detail for now because it's an exception and I want you to understand the basics. So what's more important for you to understand right now is that if you get a VAT invoice and there was no VAT charged on it like this because X is not a vendor, Y cannot claim anything. Just pointing this out to you in case some of you can remember the old rule and you're thinking I'm talking rubbish here. Okay, it's an exception, so don't worry about that for now. Okay, now we have our next example. X is a VAT vendor and makes 0 rated supplies. Y is also a VAT vendor. Okay, so the concept. So X sells goods for 100 rands, charges VAT at 0%. That means the VAT is null. So 100 times null. So the total is 100. Okay, X, this is the cash flow again, collects a total of 100 rands, pays output tax to source of null, right? And that means collects 100 rands net. Y pays this 100 rands there, collects input tax, and how much input tax do they collect? Whatever the invoice says, just null. So that means they pay a net amount. Source, okay, as output. How much is the output? That amount there, null. Or if you wanted to say that amount there, and this input is that amount over there, which is also null. So net is null. Now, I want you to see in the previous example, source also made null. We had the same type of situation here. It looked the same, the amounts, but I want you to understand there's a big difference. In this case, X was not a VAT vendor, so it had no VAT to charge. In this case, X is a VAT vendor, but the VAT is just calculated at 0%. Okay. Now I know you might say, but okay, but what's the point behind that? Why are you even saying that? So let me quickly just explain to you. Okay, let's say there was another VAT vendor over here called VAT vendor A. And VAT vendor A sold to X. And VAT vendor A gave an invoice of some goods that said selling X VAT. Let's just make it 200 rands just to make it a little bit different. And VAT was 15% because they're not a VAT vendor of null. So it'd be 30 rands. So total would be 230. Okay, what would happen here is that X would pay that total of 230 rands. I'm doing a cash flow for X here. The input tax that they would claim is that input tax over there. They would be able to claim it. So that the total, or the net amount would be 200. So what I want you to understand is that if X makes a zero-rated supplies, it means that if X goes and buys something from someone and they get a VAT invoice, like we have here, X can still claim that amount on the invoice as input tax. Even though their output tax, this is their output tax over here, and here, is going to be null, they can still claim it. So can you see this is beneficial for X? Now you'll see, I'm not going to go into all the detail of that right now. I just want you to understand the principle. But these zero-rated suppliers are things that the government tries to support. So for example, if X makes brown bread or raw vegetables, those are two common examples. They will sell their brown bread and the raw vegetables in this way. They will not charge VAT. But all the costs that they incur, if they have invoices like this, they could claim. So SARS and the government supports X in making brown bread and selling raw vegetables because it's important to the economy and they try and achieve some goals for it. For example, brown bread and raw vegetables are used sometimes by or often used to support people that can't necessarily go and afford to buy cooked food and processed food that's already been made by someone else. So it supports, for example, poorer communities. Right. That's what the idea is behind zero rating. Now, our next one that I want us to look at is X makes exempt supplies and Y is a VAT vendor. Right? So X sells for 100 rands. VAT they can't charge because they're exempt. So that's 100. Okay. So X cash flow, the total that they receive is this 100. Let's call it the same still. The output tax is that amount there, which is exempt. So the net amount is 100. Y is a VAT vendor. So Y wants to claim that cash or that amount, but let's just see. So the total that they will pay is this 100 rands over here. The input tax that they want to claim, they can't. What is the input tax? You can only claim the amount on the invoice, which is exempt. So the net amount for Y is 100. When we look at SARS, the output is exempt. The input, there is no input, so just call it also exempt. So SARS is in no position. So I'm just going to take you back. This previous one we looked at, where X makes zero-rated supplies, they also had null VAT here. Here you see they also have null VAT, but they're making exempt supplies, not zero-rated. So what's the big difference? Okay, so I'm going to quickly do the same as I did with the previous one. So let's say here's A sells to X. Here's the invoice. The selling price X VAT, let's say is 200. The VAT, and A was a normal VAT vendor, charged 30 rands. So the total is 230 rands. X now is making exempt supplies. Exempt supplies are non-taxable, so not taxable supplies. Remember when we had our, if I take you back to the slide said there's two different taxable supplies that you get, 15% and 0%, but exempt supplies are not. Okay, so now when X makes these exempt supplies, this is the cash flow on this transaction over here. The total that they will pay is 230 rands, which is the amount on the invoice. The VAT that they can claim, right? So input, we're calling it input VAT now there. Remember, we call it input tax. The input tax should be that amount on the invoice there, right? But because X is making exempt supplies, not taxable supplies, they are not allowed to claim it. So I'm going to call this exempt supply maker, right, just for now, or makes exempt supplies. So that means that the net amount is 230 for them. So understand, if you make exempt supplies, you can't claim any input tax. But if I take you to the previous one, it's a bit of a mess here now, but if you make zero-rated supplies, so in this case, X made zero-rated supplies, then you can claim that VAT. That is the big difference. And that, guys, covers the basics around VAT. You need to understand this quite well in order to progress. And again, if you haven't yet done it, please go and test that you understand this well in lecture example 1 before moving on. Don't move on until you are certain that you know this.